If you had the chance to buy a quantum stock when it was trading under $1 before the headlines, before the crowd, before the public market treated quantum computing as a real investment theme, the important question is not whether you would say yes today. Most people say yes after they see the chart. That is human nature. Once a stock has moved more than 2,000%, courage becomes very easy to imagine. The hard part was not recognizing it after the fact. The hard part was having a framework when the evidence was still early, the revenue was still small, and almost everyone else thought the opportunity was too strange to touch. That is the lesson I want you to understand. It is not that every quantum stock is going to become a 10-bagger. That would be a reckless way to think. The lesson is that great technology cycles usually become visible in pieces before they become obvious to the crowd. By the time everyone feels safe talking about them, a lot of the easy upside has already been transferred to the people who did the work earlier. I think of that as a woodshed signal. Anybody can walk onto a stage when the lights are bright and play a song, but the performance reveals whether the person spent years practicing when nobody was watching. Investing works the same way. Anyone can say quantum computing is exciting when the sector is already exploding. Anyone can chase a stock after it has moved hundreds or thousands of percent. But seeing the possibility early, when the numbers are ugly and the crowd is absent, is a different thing. Preparation matters more than prediction. I have learned that the best investors are not people who know the future with certainty. They are people who build a model of reality before the crowd needs it. They observe, they compare, they separate signal from noise. Then, when reality begins to confirm the model, they can act without being controlled by panic or excitement. That is especially important now because quantum computing is moving into a different phase. 6 months ago, there were only a few publicly traded quantum pure plays. Now there are more names, more architectures, more listings, more IPOs in the pipeline, and more investors trying to understand what is happening. The opportunity has become more visible. That also means the psychological risk has become more dangerous. The fear has changed. Before, people feared quantum would not work. Now more people fear quantum will work and they will not own it. Those two fears feel opposite, but they come from the same place. They come from the human desire to avoid regret. And regret is one of the most expensive emotions in markets. So I do not begin with the question, what should I buy? I begin with the question, what is the system? What are the competing architectures? Which companies have actual revenue? Which companies are mostly technology bets? Which companies are building hardware? Which companies are building software? Which companies are building security? Which companies have customers, contracts, and backlog? And which ones have only a story? There is a useful mathematical principle called the 37% rule. The principle says that when you are making a major decision, you should spend the first phase simply observing. You build a baseline, you learn what good looks like only after you have enough examples. Can you recognize when something is truly better than what you have already seen? That is how I would approach quantum. I would not rush into the first exciting headline. I would build the baseline, because without a baseline, you are not investing, you are reacting. And in a volatile emerging sector, reacting is how people buy the peak and sell the bottom. The most important starting point is that there is not one single way to build a quantum computer. There are multiple architectures, and for the first time, the major approaches are becoming investable in public markets. That changes the problem. You are no longer forced to make one blind bet on one architecture. You can understand the map and decide where the risk belongs in a portfolio. One of the key names is D-Wave Quantum. It matters because it represents a superconducting approach called annealing, which is designed to solve optimization problems that exist in the world. Right now, when I look at a company like this, I am not only asking whether the stock has moved, I am asking what problem the architecture is trying to solve and whether the company is showing evidence that customers care. The reason D-Wave became such an important example is that it was not only selling a dream about the distant future, its systems were being used for problems like supply chain routing, scheduling, drug discovery, and financial risk modeling. The company's full year 2025 revenue grew sharply, and the early 2026 signal became even more important when the company booked more new contracts in January and February than it had produced in all of the previous year. That distinction is important because a young technology company can have a very exciting story and still be a dangerous stock. Revenue can be growing and the company can still burn cash. Backlog can rise and the company can still miss delivery timelines. A company can be strategically important and still dilute shareholders. The system must be examined from more than one angle. The acquisition that gave D-Wave gate model capability alongside annealing also matters. It suggests the company is trying to avoid being trapped in only one path. But that does not remove the risk. It only changes the shape of the risk. The stock can still move faster than the fundamentals. the market can still overpay for the promise, and investors can still confuse a stronger signal with certainty. I do not look at these companies as lottery tickets. I look at them as probability distributions. There is upside, downside, timing risk, financing risk, execution risk, and valuation risk. A serious investor must hold all of those things in the mind at the same time. One of the key names is IonQ. It matters because it represents the trapped ion approach, using individual atoms held in place by electromagnetic fields rather than superconducting circuits. When I look at a company like this, I am not only asking whether the stock has moved, I am asking what problem the architecture is trying to solve, and whether the company is showing evidence that customers care. IonQ is important because trapped ion systems are known for precision, and precision matters when error rates are central to whether quantum systems become useful. IonQ is also one of the largest pure plays in the space by revenue and market capitalization. Its backlog expanded materially, revenue grew strongly, and the announced acquisition of Skywater Technology could give it more control over manufacturing on US soil. That distinction is important because a young technology company can have a very exciting story and still be a dangerous stock. Revenue can be growing and the company can still burn cash. Backlog can rise and the company can still miss delivery timelines. A company can be strategically important and still dilute shareholders. The system must be examined from more than one angle. That manufacturing point is not just an operational issue, it can also become a defense and national security issue. When advanced computing, semiconductor supply chains, and Pentagon contracts overlap, domestic manufacturing capability can matter. But the correct conclusion is not that IonQ must win. The correct conclusion is that IonQ has a different kind of strategic optionality, and optionality still has to be bought at a price that makes sense. I do not look at these companies as lottery tickets. I look at them as probability distributions. There is upside, downside, timing risk, financing risk, execution risk, and valuation risk. A serious investor must hold all of those things in the mind at the same time. One of the key names is Rigetti Computing. It matters because it represents superconducting gate model technology, which puts it in competition with some very powerful players. When I look at a company like this, I am not only asking whether the stock has moved, I am asking what problem the architecture is trying to solve and whether the company is showing evidence that customers care. Rigetti is a good example of why investors must read beneath the headline. A large share of its estimated 2026 revenue depends on a limited number of contracts, including an order connected to India SC, DAC Research Organization, and additional hardware delivery commitments. Some timelines have shifted, and in quantum hardware that is not unusual, but it is still important that distinction is important because a young technology company can have a very exciting story and still be a dangerous stock. Revenue can be growing and the company can still burn cash. Backlog can rise and the company can still miss delivery timelines. A company can be strategically important and still dilute shareholders. The system must be examined from more than one angle. Hardware slips, engineering roadmaps change. Customers wait, governments delay. In a mature business, one delay can be manageable. In an early-stage quantum business, delays can change the market's confidence quickly. If you own a company like Rigetti, you are really betting on execution, on the superconducting roadmap, and on the ability to narrow the gap with larger technology leaders. I do not look at these companies as lottery tickets. I look at them as probability distributions. There is upside, downside, timing risk, financing risk, execution risk, and valuation risk. A serious investor must hold all of those things in the mind at the same time. One of the key names is Quantum Computing Inc., often known by the ticker cut. It matters because it represents one of the highest risk names in the public quantum group. When I look at a company like this, I am not only asking whether the stock has moved, I am asking what problem the architecture is trying to solve and whether the company is showing evidence that customers care. This is where I would slow down the most. The revenue base has been extremely small. The company's filings have carried serious warnings, and it has faced securities fraud lawsuits along with allegations from short sellers about the nature of certain relationships and revenue claims. Those are not small issues. That distinction is important because a young technology company can have a very exciting story and still be a dangerous stock. Revenue can be growing and the company can still burn cash. Backlog can rise and the company can still miss delivery timelines. A company can be strategically important and still dilute shareholders. The system must be examined from more than one angle. A tiny revenue base, promotional excitement, legal uncertainty, and large investor attention can become a combustible mix. It does not mean the company cannot succeed. It means the range of outcomes is very wide, and a wide range of outcomes requires strict position sizing. The job is not to fall in love with every dream. The job is to determine which dreams have enough evidence to justify the risk. I do not look at these companies as lottery tickets. I look at them as probability distributions. There is upside, downside, timing risk, financing risk, execution risk, and valuation risk. A serious investor must hold all of those things in the mind at the same time. Those established names cover important parts of the market, but the more interesting change is that the investable universe has widened. New entrants have brought other architectures into public view, and that changes how the sector can be analyzed. One of the key names is inflection. It matters because it represents the neutral atom architecture, which may have scaling advantages because it can potentially reach large numbers of qubits without some of the same engineering constraints. When I look at a company like this, I am not only asking whether the stock has moved, I am asking what problem the architecture is trying to solve and whether the company is showing evidence that customers care. What makes inflection interesting is not only the architecture, it is the combination of NVIDIA selection, quantum computing work, and quantum sensing revenue. The sensing side matters because it can produce deployed hardware and revenue earlier than full-scale quantum computing. The company already had meaningful revenue for such an early public quantum name, and it has guidance that suggests commercial traction. That distinction is important because a young technology company can have a very exciting story and still be a dangerous stock. Revenue can be growing and the company can still burn cash. Backlog can rise and the company can still miss delivery timelines. A company can be strategically important and still dilute shareholders. The system must be examined from more than one angle. A dual revenue stream changes the risk profile. It does not make the company safe, but it means the company may not be entirely dependent on one binary outcome in an early technology cycle. Businesses that have more than one path to survival are often worth watching more closely. I do not look at these companies as lottery tickets. I look at them as probability distributions. There is upside, downside, timing risk, financing risk, execution risk, and valuation risk. A serious investor must hold all of those things in the mind at the same time. One of the key names is Xanadu. It matters because it represents the photonic architecture, using photons and operating with a different engineering profile than systems that require extreme cooling. When I look at a company like this, I am not only asking whether the stock has moved, I am asking what problem the architecture is trying to solve and whether the company is showing evidence that customers care. Xanadu is easy to misunderstand. If you look only at the hardware, the Aurora system and the room temperature advantage are important, but the software layer may be just as important. Xanadu built Penelane, an open-source quantum programming framework with broad developer adoption and rapidly growing usage that gives the company a second possible path beyond winning only on its own hardware. That distinction is important because a young technology company can have a very exciting story and still be a dangerous stock. Revenue can be growing and the company can still burn cash. Backlog can rise and the company can still miss delivery timelines. A company can be strategically important and still dilute shareholders. The system must be examined from more than one angle. In many technology cycles, the platform and the tools become as important as the machines. If Penelane becomes a standard across architectures, Xanadu's value may not depend only on photonic hardware winning everything. But revenue remains early, the stock has been volatile, and the business is still speculative. That means the thesis is interesting but not yet proven. I do not look at these companies as lottery tickets. I look at them as probability distributions. There is upside, downside, timing risk, financing risk, execution risk, and valuation risk. A serious investor must hold all of those things in the mind at the same time. One of the key names is Horizon Quantum. It matters because it represents hardware, agnostic quantum software, which is designed to work across whichever architecture gains traction. When I look at a company like this, I am not only asking whether the stock has moved, I am asking what problem the architecture is trying to solve and whether the company is showing evidence that customers care. This kind of company sits in a different part of the stack. It is not trying to prove that one hardware architecture will dominate. It is trying to become the middleware and software layer that helps the whole field work. In a young sector where the winning hardware is still uncertain, that can be an intelligent position. That distinction is important because a young technology company can have a very exciting story and still be a dangerous stock. Revenue can be growing, and the company can still burn cash, backlog can rise, and the company can still miss delivery timelines. A company can be strategically important and still dilute shareholders. The system must be examined from more than one angle. But hardware agnostic does not mean risk-free. The company still has to prove demand, revenue, durability, and scalability. A good position in the stack is not the same as a good business until customers pay for it consistently. I do not look at these companies as lottery tickets. I look at them as probability distributions. There is upside, downside, timing risk, financing risk, execution risk, and valuation risk. A serious investor must hold all of those things in the mind at the same time. There are also micro-cap names in quantum security, including CLSQ and Arcit. They address post-quantum encryption, which could become a major issue if quantum machines become powerful enough to threaten today's encryption. That is a real problem in principle. But these companies are extremely early. They may multiply if the market begins to price the threat aggressively, or they may lose most of their value if revenue does not arrive. That is why they belong in a very different risk bucket from large infrastructure companies. The IPO pipeline also matters. Quantinuum, majority owned by Honeywell, has been targeting a large public valuation. IQM out of Finland and Pasquale out of France are also part of the coming wave. If those listings arrive, the public market could have 8 or more quantum pure plays across superconducting, trapped ion, neutral atom, and photonic approaches that has not happened before. And it fundamentally changes the portfolio construction question. When a sector has only 1 or 2 public names, investors tend to make binary decisions. They either buy the available stock or ignore the theme. When the sector becomes a full investable universe, the better question becomes how to build exposure without letting one failed company, one failed architecture, or one failed management team destroy the entire thesis. This is where the infrastructure layer becomes essential. Amazon Web Services hosts several quantum hardware providers. Microsoft Azure hosts multiple providers as well. NVIDIA's software platform integrates with a large share of the world's quantum processors, and NVIDIA has backed important private quantum companies through venture investments. These companies do not need quantum to succeed in order to remain strong businesses. But if quantum succeeds, they can act like toll collectors. In a gold rush, miners may become rich, but many miners fail. The suppliers of tools, platforms, infrastructure, and distribution can win across many different outcomes. In quantum computing, the cloud platforms, the semiconductor platforms, the software frameworks, and the infrastructure companies may make money regardless of which specific pure play becomes the champion. That is why I would not build a quantum strategy only around the smallest and most exciting names. That is usually the emotional approach. The more systematic approach is to combine infrastructure with pure plays in a small dream bucket. The goal is not to maximize excitement. The goal is to maximize the chance of surviving long enough to benefit if the cycle becomes real. So are quantum stocks still good entry points today? The honest answer is maybe. That answer is less exciting than a prediction, but it is more useful. A sector can be real and still be expensive. A company can become an important long-term winner and still fall 50% before the thesis works. A revolutionary technology can punish investors who buy at the wrong emotional moment. Remember the 37% rule. The first phase is the look phase. You learn the companies, you learn the architectures, you learn who has revenue, who has backlog, who has contracts, who has lawsuits, who has software adoption, who has government exposure, who is burning cash, and who is issuing shares. Once you have that baseline, the next price move does not control you. You can ask whether the move is signal or noise. Was there a real contract? Was there a manufacturing breakthrough? Was there meaningful revenue? Was there dilution? Was there a customer win? Was there only a press release? This is the difference between investing with a framework and chasing a chart. Most people lose money in emerging technology cycles not because they are unintelligent, but because they cannot separate excitement from evidence. They confuse a moving price with validation. They confuse a good story with a good system. They confuse being early with being right. Quantum will create that mistake over and over again. The psychological signal right now is important. The fear has flipped. When people feared quantum would not work, they did not want to buy. Now that they fear quantum will work without them, they want to chase. That is the same fear pointing in a different direction. When you feel that fear, it is not a buy signal and it is not a sell signal. It is a pause signal. Pause and ask whether the decision is calibrated or emotional. Ask whether the evidence improved or whether only the price moved. Ask whether the position size matches the uncertainty. Ask whether you are treating a speculative hardware company like a mature business simply because the theme feels important. Early-stage quantum companies are especially difficult because nearly all of them burn cash and issue shares to survive. That means the business can progress while your ownership is diluted. A company can raise capital to survive, and survival may be good for the company. but dilution can still reduce your slice of the future upside. This is one of the hardest lessons in speculative investing. The company can be right and the stock can still be difficult. A brilliant technology with a weak balance sheet may force repeated capital raises. A promising business with a soaring stock price may become vulnerable to disappointment. A sector with massive long-term potential may still produce terrible short-term returns for undisciplined buyers. The practical question is not whether quantum is exciting, it clearly is. The practical question is how to size uncertainty intelligently. If I were thinking about a $100 quantum allocation as a system, I would divide it into tiers rather than letting emotion decide everything. The anchor would be the infrastructure layer. Around $50 would go there because those companies generate real cash flow today and can benefit from quantum without depending entirely on it. They are the toll collectors, the platforms, and the companies with multiple ways to win. The next portion would go to the pure play builders, perhaps around $35. These are the companies where quantum is the whole business. This is where the potential upside can become much larger if commercialization accelerates. It is also where the risk is higher because timelines can slip, cash can run out, and dilution can be severe. The final portion would go to the highest risk dream bucket, perhaps $15. This is where the very early software, security, photonic, encryption, or microcap names belong. A breakthrough can multiply the money, a failure can erase it. This is not retirement capital, it is not emergency capital, it is not money you need to protect your life, it is risk capital. This tiered approach is not about the exact percentages. It is about forcing the mind to respect uncertainty. Poor sizing is how people turn good themes into bad outcomes. They either ignore a cycle because it looks speculative, or they bet so aggressively that the first major drawdown forces them out. There are also quantum-focused ETFs now. A basket can make sense for investors who do not want single company risk, but a basket of speculative assets is still speculative. Diversification inside a young sector reduces one kind of risk, but it does not eliminate sector risk, valuation risk, or technology risk. You still need to know what the fund owns and how concentrated it is. So where does this leave us? It leaves us at the beginning of a more investable quantum era, not at the end of one. The architectures are visible, the public universe is expanding, the infrastructure companies are positioning themselves. The pure plays are trying to prove commercial traction. The software layers are gaining adoption. The security companies are waiting for the post-quantum problem to become urgent. The IPO pipeline is coming. All of that is real. But dilution is also real. Cash burn is real. Hardware delays are real. Lawsuits are real. Overpromotion is real. Valuation risk is real. Investor psychology is real. The opportunity becomes more dangerous precisely when it becomes more obvious. That is why I would approach quantum with openness and caution at the same time. Openness because the potential is too important to ignore. Caution because the evidence is not mature enough to justify blind conviction. The best investors are not permanently optimistic or permanently pessimistic. They can hold both sides of reality at once. Quantum computing may change the world. Many quantum stocks may still fail. Both statements can be true. That is why the woodshed matters. That is why the baseline matters. That is why the 37% rule matters. You observe first, you compare, you separate architecture from hype, revenue from press releases, adoption from speculation, and risk from fantasy. Then, if you act with a position size that allows you to remain rational after the first major drawdown. The market will test you. If quantum becomes a major technology cycle, it will not move in a straight line. It will move violently, it will create fortunes, and then take them away from people who confuse temporary gains with permanent skill. It will reward preparation and punish impulse. The people who benefit from these cycles are rarely the people with the loudest opinions. They are the people who build a framework before the crowd arrives, understand what they own, size risk correctly, and refuse to let fear make their decisions for them. The opportunity is not only in quantum, the opportunity is in seeing clearly while other people are moving between disbelief and euphoria. In 2023, the market rewarded the people who had done the work before the crowd understood the signal. In 2026, the work has changed. The crowd is beginning to understand, so discipline matters more, not less. You need a baseline, you need a system, you need sizing, you need patience, you need to know when you are seeing evidence and when you are simply feeling FOMO. That is how you approach a possible 10-bagger without turning yourself into a gambler. You do not need to predict the future perfectly. You need to prepare better than the people who only notice the future after it has already been priced in.